Greetings, everyone. Well, it certainly has been a pretty wild time in the market, and we are here for you in terms of communicating what we know or what we understand at the moment, and that's what I'm here to do, as usual, on Employment Friday. So normally, and today, we will start with monetary policy, fiscal policy, economic statistics, what the markets are telling us. And then I'll share with you a little bit about our brainstorm today. We talked a lot about what is going on in the stock market, trying to put all the cross currents together. So some pretty interesting insights out of that. But first, I've been getting the question, what keeps you awake at night? And I can tell you honestly, the one thing that keeps me up at night is that as the market goes down and our strategy is punished disproportionately, what keeps me up at night is knowing that some people are going to panic if they're looking at their accounts on a day-to-day basis. We keep saying, almost every time I talk, I say we have a 5-year investment time horizon. And at the moment, we are close to, from an expectations point of view, a record in terms of what we expect from our portfolios during the next 5 years at a compound annual rate of return. I've seen it only higher once, and that was after the rout in the fourth quarter of 18. And based on our expectations at that time, we believed that our portfolios would deliver a compound annual rate of return of 42%. So that's 42% over 5 years. That's more than a quintupling. And we're just about there again. So again, ahead of just spectacular growth rates, exponential growth rates associated with the innovation platforms, so DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. And even more importantly, the convergence between and among those platforms. We believe that our companies, from a revenue growth point of view and ultimately a profit growth point of view, are going to show exponential growth rates. And we would assume, now we may not be right, but we would assume that the stocks would award them, or the market would reward them accordingly. So with that said, just let me talk a little bit about FUD, fear, uncertainty, and doubt, in a market when Chairman Powell, Federal Reserve Chairman Powell, sort of changed his mind from inflation is transitory to perhaps it's not transitory. I think that has unnerved the markets, and we've got investors and analysts fleeing back to their benchmarks. Our strategies typically include stocks that are not in the broad-based benchmarks. And so our stocks are the ones they sell in order to move back into the benchmarks. I've been through this time and time and time again. This is no different. And so we usually do the opposite. We know they're throwing our stocks out, and therefore, instead of trying to get close to any benchmark, and as you know, we don't have a benchmark, we're looking to the future, not the past, we concentrate our portfolios towards our highest conviction names and toward those stocks that have been punished disproportionately and we believe unfairly in the marketplace. And just to give you a glimpse of what I mean, our portfolios, our strategies have been associated with stay-at-home stocks because they treated us so well during the coronavirus crisis. But the point we've been trying to make is that the world has changed permanently because of the move towards increased digitalization. We're not going back. And therefore, we think that you should start thinking about these stocks not as stay-at-home stocks, but stay connected stocks, stay competitive stocks, stay globally competitive stocks, because that's what we do. We're focused on the way the world's going to work and really transformational growth. So with that, let me start with monetary policy. So M2, the growth rate of M2 is 13%, and it's been around that growth rate on a year-over-year basis since June, so five months or so. And that's down from 27% in February. And that is when a lot of turmoil started in the market, because the markets and the algorithms had gotten used to money growth accelerating. And then all of a sudden, it was not accelerating anymore. And here we are in the last 7-8 months in a serious correction for high valuation or high multiple stocks. So that was the beginning. And yet the market was reassured from time to time when Chairman Powell said, you know, inflation is transitory. We're facing there's a basis effect comparing against a year ago. We've got supply chain problems we need to work through. And when we get through them, we'll be on the other side, and pricing will fall more into line with that maximum 2% CPI. Right now, we're at a 6.2% on the CPI. That's the headline CPI. The core CPI is closer to 5%, and what the Fed watches, the core PCE deflator, is closer to 4%. But it seems as though Chairman Powell has gotten a little less comfortable with this notion that core rate was going to start to decelerate towards the 2% or less during the next year. So we'll get into that more. Our confidence has increased that inflation is going to unwind, and probably more dramatically than most are thinking right now. So now, as soon as Chairman Powell made the comment that he wasn't so sure that the inflation rate we're seeing today is transitory, the bond market did something very strange. It rallied. That means interest rates went down. That's a very curious phenomenon in this market. The Fed chairman says inflation might be more of a problem, and the bond market basically says the opposite. So very interesting. And reminiscent of another time when the bond market was right and the stock market, and the stock market was wrong, was really in the 06, early 07 timeframe, where the bond market was warning that the world was slowing down, and we had no idea how much it was going to slow down. But as we all know, it did. The other thing that has happened in here is that the yield curve has started flattening. It actually started flattening soon after money growth rates started decelerating. And in March, the difference between the 10-year government bond yield and the 2-year yield was 160 basis points, or 1.6%. Today, it's down to roughly 75 basis points, or 0.75%. Now, what does that mean? A flattening yield curve typically means that the bond market, bond investors, are fearful of either recession or pleased that inflation is coming down, or both. So it seems to be telegraphing either a recession on the horizon, inflation coming down, or both. And we would submit that we believe the economy will not drop into a recession, but we do believe there's going to be a recession scare next year, and it has to do with inventories. We believe that inventories are beginning to pile up. I've mentioned before, they've piled up in our homes as we now have hoarded for Christmas, and before we normally would during Christmas time and Hanukkah. So that's been the first source of inventory accumulation. And we see a number of other sources, and I'll go into this in a little bit more detail when we talk about the economy. So we think we'll skirt a recession, but we think that the inventory drawdown is going to cause serious dislocations in pricing, whether that's commodity prices or finished goods prices. So stay tuned for that. And the other thing that the bond market may be focusing on right now is China. China, the government, is aiming at the heart of that economy in an attempt to achieve common prosperity. Now, what is the heart of that economy? It's real estate. Real estate accounts for 75% of consumer savings in China. And pricing is coming down as the government focuses on deleveraging in the real estate market and actually getting rid of a lot of tycoons who are not consistent with common prosperity. And as I mentioned, I think on the last YouTube video, I really do believe this is playing with fire. And we're a bit concerned about how rapidly China's economy will slow down. It already has slowed down, but how much more does it have in front of it in terms of a slowdown? And we are watching some commodity prices suggest, like iron ore, down more than 50%, suggest that perhaps the slowdown there could turn into an outright recession, which China has not seen in more than 20 years. So we're watching that, and we don't know why more people are not talking about it. The bond market could be ferreting out some real problems in China. So on to fiscal policy before we head into economics and the markets. So I guess the most relevant thing going on right now is that the Senator Manchin somehow feels emboldened to stand against this fiscal package, which is trying to move through Congress. And I think that he will be successful. The odds are increasing that he will be successful. So he's focused on debt, inflation, and taxes. And he got an earful from his constituents in West Virginia when he went back for Thanksgiving vacation. And they were complaining about oil and gas prices. So I think he's been further emboldened, and I think he's bringing other senators along. And so we're optimistic that at the very least, the most onerous taxes that are a part of that bill, if it sees the light of day, that the most onerous taxes will not be there. And that's a very good thing. Okay, on to the economy. So Employment Friday, always very interesting. The unemployment rate dropped fairly dramatically, even though non-farm payrolls disappointed. They were about half the growth that the market was expecting. Now, what's happening? Well, the labor force, believe it or not, is shrinking. And that is a very curious thing when we have more than 10 million jobs going unfilled right now. So what is going on? And this was part of our discussion this morning at our brainstorm. And the topic of DeFi and DAOs, distributed autonomous organizations, and NFTs came up. It seems as though there are a lot of people who have become a part of this movement. Many young people who graduated from terrific colleges are leaving their engineering and other jobs at Google and Facebook and Amazon to pursue this dream. And they don't even know really where they're going. They're experimenting, they're exploring, and they're trying to find their way in this new world. It's really could define the future of work, where it will be itemized. You have the scale of the internet to support new distributed autonomous organizations. And we think while it's somewhat difficult to understand right now, it will become clearer. I always say follow the developers, and that's what we're doing. And they are scrambling into this new world much more rapidly than they scrambled into the internet, I believe, in its early days, or I know, again, because we do watch the developers. So that could be causing significant distortions in ways that we won't understand perhaps for years. And certainly the economic statistics are not going to keep up with this. They're going to be revised and revised and revised until the government really has a handle on it. And that could take 10 years. So we're probably going to continue to be puzzled by employment reports going forward. Interestingly, in this report, while non-farm payrolls, which really is a survey of corporations, establishments, that metric disappeared. Household employment, which takes into account more small businesses, mom and pop, self-employed, that metric was up 1.1 million units. That's a very strong number. So I would not consider this employment report weak. And in fact, there was another metric in it that I found very interesting. The average work week up about 0.5%. Now, that's a very strong metric, and it more than offsets the disappointment in non-farm payrolls. So if we look at average hours worked for the fourth quarter, just kind of get a sense of what that's going to be, it could be more than 5% at an annual rate. Now, if you slap a little productivity on top of that, you could have a 7% real GDP growth quarter, which would be phenomenal. But somehow the market isn't very excited by this. Now, why might that be? Before I get there, I'll just mention one other metric in the employment report, average hourly earnings. They disappointed on the low side of expectations. They were up 0.26%. Expectations were 0.4%. And on a year-over-year basis, they're back down to 4.8, having touched 5% in the original report. So that's interesting, because those who are fearing inflation remember or have read about the wage price spiral that plagued the US economy and many other parts of the world in the 70s. Well, that's not happening, at least not yet. So that's a very important number. And oh, by the way, 4.8% on a year-over-year basis, if we are right and productivity is going to move up 2 to 3 to 4% in the next few years, then we should have wage growth in that range as workers become more productive. So let's see. Then the next thing that I'd like to talk about is this conundrum. Why isn't the bond market reacting to the potential of a very strong growth number like that? That's real GDP growth in the 7% range. And why isn't it reacting to inflation? And I think the reason is it's looking to the future and looking at a huge inventory pileup. And we have some early evidence from companies that is indeed the case. So in the case of retail, both Nordstrom and Gap on the same day reported that their sales were flat to down if you compare third quarter of this year to the third quarter of 2019, pre-pandemic, to get the pandemic distortions out of the way. Sales are down from that level. And inventories, in the case of Nordstrom, inventories are up 13%. Sales are down, Inventories up 13%. In the case of Gap, their sales were down. This quarter, or in the third quarter, their inventories were flat, but they're projecting 7 to 8% inventory growth in the fourth quarter. And I think they're disappointed by what they're seeing in the fourth quarter on the sales front. That would make sense. We also got word that from Adobe, which measures online sales during Cyber Sunday or Cyber Monday and Black Friday, that weekend. And it looks like online sales are negative. Online sales negative year over year. Now, online is responsible for about 20% of retail sales, and those are down. That is not a good sign, especially because many of us still seek the convenience of online instead of going into stores for our purchases. Another few numbers came out on the inventory front, very interesting, on the wholesale level. So on its way to retail. In August and September, wholesale inventories increased 1.1 and 1.4% month to month. So that's maybe 15% at an annualized rate. I think inventories are building and building fairly dramatically. There's another very interesting retail phenomenon taking place right now, and we've talked about this before. It's in the auto space. Now, I mentioned last month that auto sales surprised on the low side of expectations, and the auto companies were saying chip shortages. That number was 13 million units at an annual rate. This is here in the United States. Well, this last month, November, they were 12.86. Their expectations were a little bit of an increase now that automakers are saying the chip shortage is diminishing. But instead, they went down. And I think what this is saying is that a lot of consumers bought that extra car during the pandemic to avoid mass transit, and they're going to wait for a while before the next car, wait until electric vehicle prices come down further, or wait until they actually need a car. So I think that part of the story is also playing out. Now, what I'm talking about is on the good side, autos, retail sales. That's primarily goods, durables, non-durables. And this is what we had been expecting for quite some time, that they would disappoint, and that businesses which had been scrambling to build inventories because their shelves were going bare during the coronavirus have now ordered too much, and we are going to have a significant inventory overhang. In fact, I wouldn't be surprised if a lot of that 7% growth in the fourth quarter, that's an annualized quarter-to-quarter growth rate, is in inventories. And in fact, in the third quarter, which we know already, real final sales were flat, and GDP was up. Real GDP was up 2%. All of that was in inventories, all of it. And so very interesting. I don't think this inventory story is being told. What is holding the economy up to some extent is services. We just got ISM services, so purchasing managers talking about services, and it went out, the index went out to an all-time high, 69, and I went back into the 90s to see if I could find anything higher. So services, there is this shift away from goods towards services. And I think that's what keeps us out of a recession. Okay, on to markets. We've talked a little bit about fixed income. Now, at commodities. Commodities are confirming, with oil now starting to do so as well, that there may be a little bit too much inventory out there. We have copper prices down 13%, although they haven't broken their uptrend. They are flattening out. We've got lumber prices still down 47%, even though they've picked up recently. I understand that the stumpage, so logs, those prices haven't gone up at all. We've got oil finally cracking. I think today it's at $66 from 85. And as you know, we did not expect 85. So that's down 23%. We've got iron ore, as I mentioned earlier, down 40 to 50%. And we've got DRAM prices, so digital commodities, down 30%. All of these are since May. Most of them are since May. We've got the Baltic Freight Index has had a significant move down, which confirms that supply chains are loosening up. So that's good. The dollar is up 8% thus far this year, since January, which doesn't sound like a lot, but it can have incredible ramifications throughout the rest of the world. We see in Turkey, the Turkish lira is down 50% since February. You know, the poor people in Turkey have lost 50% of their purchasing power relative to the dollar, and maybe 50% of their wealth or more. So this is what typically happens when the dollar goes up, and especially in economies that have a lot of dollar-denominated debt. So I think we're going to see a lot more of this, and some of it is exposed to Chinese real estate as well. So I think we're going to see some more turmoil in the debt markets. Now, the stock market, again, year to date, we've got energy up 45%. We've got financial services and real estate up roughly 30%. Value has been screaming this year. But I have just given you a scenario that would put a screeching halt to that value, that move toward value stocks. And that's this inventory buildup. The value stocks are the ones most exposed to it. So we'll see what happens. And in fact, Nancy Lazar of Cornerstone Macro has likened what could happen now to the flip side of Y2K. So in the move up to Y2K, companies scrambled to buy and install as much technology as possible, refreshed all of their tech ecosystems because they didn't think their computing systems would be able to handle the switch from 1999 to 2000. And then the rest is history. It ended in tears, of course, for the technology sector. What's happening now is the technologies, the seeds for the technologies today that are evolving these 5 innovation platforms, they were all planted in the 20 years that ended in the tech and telecom bubble. And they've been germinating for 20 to 25 or 30 years, and they're ready for prime time right now. The costs are ready, meaning they're low enough, and the technologies are ready. Meanwhile, in the tech and telecom bubble, value looked like it had 2 left feet, couldn't do anything right. And it got worse as time went on. And of course, value was the big winner, the very big winner for years coming out of the tech and telecom bust. I think that the innovation stocks that have been pummeled in here, many of them are a quarter to a third of where they were earlier this year. I believe they are going to be the big winners once we confirm that the inflation is transitory, that there's a recession risk out there. And when there's a fear of a recession, value stocks get hit hard. And I do believe there is something to this. And when inflation gets hit, value stocks get hit hard. So stay tuned for that. The other thing that I'd like to tell you, now these are just our strategies, but my guess is other innovation-oriented portfolios would have these sorts of opportunities. At the peak in February, our strategies, according to our estimates, which, as you know, Wright's Law plays a central casting role, our strategies, we believed, were going to deliver a 15% compound annual rate of return over the next 5 years. So that's a doubling over 5 years. Not bad, nearly twice as much as what equity markets typically deliver over time. Today, assuming that our valuations are crushed down to FANG-like multiples in 5 years, we believe that our strategies, certainly the flagship, all of the innovation platforms together, are going to deliver close to a 40% compound annual rate of return. That's a quintupling over 5 years. So we actually are much more comfortable today than we were in February in terms of the outlook for our strategies. And now I'll just share a few more things from Brainstorm today. What's causing indigestion in the markets? It could be tax loss selling, that should be winding up pretty soon. It could be leverage in the marketplace. We know that a lot of maybe especially younger people have taken on leverage, but I think the leverage in the ecosystem was high enough to suggest that many others were on margin as well. So we're certainly seeing that cleaned out and resetting. Another thing that came out when we were talking about why would they be punishing our stocks when all of these signs of deflation and slowdown are starting to crop up. And I think many people who attend our brainstorms regularly concluded that, most people have never seen exponential growth. And they certainly haven't seen convergence of exponential growth trajectories that we see, for example, in autonomous taxi networks, the convergence of robotics, energy storage, and artificial intelligence. So one S-curve feeding another S-curve. We think that delivers $10 trillion in revenues in year 10 in 2030. Now, if that's right, that's from zero. The returns are going to be phenomenal for any company involved in that particular space. And we also have a lot of behavior, especially during risk-off periods, that is informed by the past. Algorithms just use past in order to determine what to sell and what to buy. And that certainly is true this time. Algorithms are pretty mindless when it comes to the future. In fact, they don't incorporate anything about the future. And more than half of the trading volume we believe today is algorithm driven in some way, shape, or form. And then the last thing I'll say is a lot of people, at least on the brainstorm, are a little unnerved by what's going on in the labor markets. Just confusing. And these are very experienced professionals. They've run companies, and this just doesn't make sense to them. And so when we happened upon the, hey, the transformation of the world thanks to DeFi and DAOs and NFTs is probably going to be a lot bigger or more profound than anyone can now anticipate, and will impact the labor markets importantly. And so we're going to be doing a lot more research on that. And so on this Friday in the winter, or soon to be fully winter, instead of staying at home, you should stay connected and stay competitive and stay globally competitive. And for any corporations who are listening to that, or other businesses, you need to embrace these new technologies because they're going to be transformational. And if you don't embrace them, you're not going to win. In fact, you may not be around. So with that, I'd like to thank you and once again express our confidence in our strategies over the next 5 years. And and just hope you'll join us in some way, shape, or form, even by just reading up on these strategies on ark-invest.com, and just to help you understand how much the world is going to change. So thank you very much.